Welcome to my channel CA Final Academy, and today we are going to deal with a very important topic, that is double taxation and avoidance agreement, where we are going to study about section 90, 90A and 91 as per Income Tax Act 1961. Imagine this: you are an Indian resident, you earn rupees 10 lakhs in India, you are also earn rupees 5 lakhs from USA. India says, you are my resident, I will tax your global income. Okay. USA says, income earned here, I will tax it too. Same income, taxed twice. This is called double taxation. And trust me, in exams, this is where you get stuck. So today, let's master section 90, 90A and 91 like professionals. What is double taxation? Double taxation arises when same income taxed in two different countries in the hands of the same person for the same assessment year. Two main reasons: residence rule. Country taxes global income, India follows this rule for residents. Source rule, country taxes income arising in that country. When both apply, double taxation. Relief from double taxation. Three routes. The Income Tax Act provides relief under section 90 when India has DTAA with another country. Double taxation agreement. Okay. Then when agreement is with specified foreign association, then they follow section 90A, and when no DTAA exists, section 91 prevails. Section 90, DTAA with foreign countries. Under section 90, the central government enters into DTAA with foreign countries. India has DTAA with countries like United States, United Kingdom, Singapore, UAE. Purpose: avoid double taxation, prevent tax evasion and exchange information. Methods of relief under DTAA. Two main methods. Exemption method, income tax in one country, exempt in another. Tax credit method, most important. Tax paid in foreign countries allowed as credit against Indian tax liability. India mostly follows tax credit method. Okay. If there is a conflict between Income Tax Act and DTAA, then whichever is more beneficial to the assessee, that applies. This line is very important. Now section 90A, agreement with specified associations. This section applies when agreement is entered with specified associations in foreign countries, not directly government to government, practically similar to section 90. Okay. Section 91, unilateral relief. No DTAA case. No, suppose India has no DTAA with a country, example income earned in a country where India has no agreement, then section 91 gives relief. Conditions: assessee is resident in India, income accrued outside India, income taxed in foreign country. No DTAA exists. How calculation will be done under section 91? Relief will be lower of Indian tax rate or rate of tax, foreign rate of tax applied to doubly taxed income. This is called unilateral relief. Okay, let's take an example. Mr. A, resident, Indian income 10 lakhs, foreign country income 5 lakhs, tax paid in foreign country 75,000, Indian tax on total income 3 lakhs. If DTAA exists, section 90, foreign tax credit allowed. If DTAA does not exist, section 91, relief lower of the tax. Now we have to have a quick differentiation between the two, that is section 90 and 91. Okay. Section 90, DTAA required, yes. Section 91, DTAA is not there. Okay. Nature of section 90 is bilateral relief, whereas in 91, section 90, it is unilateral relief, right? Method as per agreement, okay, and for the section 91, it is beneficial provision. Okay. Important amendments and concepts for 2026. Treaty override. DTAA overrides Act if beneficial. TRC, tax residency certificate. To claim DTAA benefit, assessee must provide TRC from foreign country. Okay. GAAR versus VDTAA. If treaty abused, GAR provisions will apply. We will discuss it later on. Okay. So for such a question, how we will attempt in examination to score marks? Okay. First, what will you do? You have to first, any question comes on DTAA, first do one thing, define double taxation. Second, mention the reasons, residence plus source rule. Explain section 90, then explain section 98 briefly. Explain section 91, unilateral relief. Okay, and then conclude by saying this, which I have a case study which have been given to you. For just to remember, 90 with agreement. 90A, association agreement. 91, no agreement. So just to remember it, 90, whenever section 90 comes, with agreement. 90A, association agreement. Section 91, no agreement. Okay. This chapter is not about memorizing sections, okay, it is about understanding taxation power of countries, okay. So if you understand residence rule, source rule, relief mechanism, it will be clear to you, okay. So this is the core conceptual base of double taxation. If you properly understand these three, section 90A, 90A and 91 becomes very simple. What is residence rule? Let us do one by one. Residence rule says, what does it say? Tax me because you belong here. Imagine this, you are a resident of India. India says you live here, you use my roads, hospitals, legal systems, infrastructure, so I will tax your global income. This is called the residence principle of taxation, meaning a country taxes its residents on their worldwide income. India follows this rule for residents and ordinary residents. So if you are resident in India, income earned in India will be taxable, income earned in USA will be taxable, income earned in Dubai will be taxable because you belong to India. Simple, let's take an example. Mr. A, we have already taken this example, resident of India, salary from India 10 lakhs, consultancy income from USA 5 lakhs, India will tax on 15 lakhs. Why? Because he is resident as per residence rule. Second is source rule. What does source rule says? Tax me because you earned here. Okay. Now think from another country's perspective. USA says this income was generated in my country, so I have the right to tax it. This is called the source principle of taxation, meaning a country taxes income that arises within its territory, irrespective of residence. So even if you are an Indian resident, if income arises in USA, USA can tax it. Same example we can continue to understand clearly. Income arose here. I will tax rupees 5 lakhs. Mr. A had 5 lakhs from USA. India says, you are my resident. I will tax on 15 lakhs. Same rupees 5 lakhs taxed twice. This is double taxation. Okay. Now let's understand relief mechanism. Let's avoid unfairness. Now logically understand. It is fair to tax same income twice? No. So government enters into agreements or provide relief. This is called relief mechanism. There are three possible ways. Exemption method. One country says, I will not tax this income. Example, foreign income is exempt in India. Okay. Second, what we will say, the second method is tax credit method. Okay. India taxes global income but gives credit for foreign taxes paid. Example, foreign income was 5 lakhs. Taxes paid in USA, 75,000. Indian tax liability, 3 lakhs. India allows 75,000 as credit because tax is already paid on that income. Final tax payable in India will be 3 lakhs minus 75,000. This avoids double burden. India mainly follows this method under section 90 and 91. Now unilateral relief. When no DTAA exists, okay, India still gives relief under section 91. Relief, lower of Indian tax rate or foreign tax rate applied on doubly taxed income. Okay, now connect all the three. Okay, let's connect them logically concept. Who is claiming right? Why? Residence rule, country of residence, you belong here. Source rule, country where income arises, income generated here. Third, relief mechanism, both adjust to prevent double taxation. Double taxation arises due to conflict between residence-based taxation and source-based taxation. Relief is provided through DTAA section 90 or 90A or unilateral relief, that is section 91. Okay. Real life, let's take an example. Just imagine you are a citizen of a family, okay, and the family is your regular residence. Okay, you also work for the company. Source, where you're getting the money. Family says you are ours, company says you earned here. If you take full salary, both take full salary, unfair. So adjustment is made. That adjustment is relief mechanism. Okay. So if you remember this residence rule, global income taxable, source rule, local income taxable, clash, double taxation, solution is DTAA and relief. So I hope this point is clear to you. Section 90, section 90A, 91, residence rule, source rule and relief methods, exemption and tax rate. Okay. Example 1, basic residence rule, global income taxation. Case 1, Mr. A is resident of India. He earns rupees 10 lakhs in India, rupees 5 lakhs in UK. UK taxes 5 lakhs at the rate 20% Okay. Now first what will you do? Total income in India is 10 lakhs plus global income. We remember apply residence rule. India taxes global income because Mr. A is resident. Okay. Total in India is 10 lakhs plus 5 lakhs. Okay. Because he was earning rupees 10 lakhs from Indian and 5 lakhs from UK. So his total income is now 15 lakhs. Okay. Assume Indian tax rate 30%. Indian tax rate on total income is 30% of 15 lakhs. 15 lakhs is total income, global income. Over that 4,50,000. Okay. Now step 2. Foreign tax credit. Section 90 DTAA exists between UK and India. Tax paid in UK is 20% of 5 lakhs. Okay. 5 lakhs is earned in UK. So 20% of that will be 1 lakh. Indian tax on the foreign income, we have to find it out. Now for taking the benefit of section 90 DTAA, what will we have to do? Find out the Indian tax on foreign income. Foreign income was 5 lakhs. Okay. 30% of 5 lakhs will be 1,50,000. Now tax paid in UK, 20% of 5 lakhs, that is 1 lakh. And tax paid in Indian, as per Indian tax rate, it is 1,50,000. Credit allowed will be lower of foreign tax paid or the Indian tax paid on foreign income. So credit allowed will be 1 lakh. It was 1 lakh, it is 1,50,000. So final Indian tax payable will be 4,50,000 he was supposed to pay. Over that, from that he will be deducting rupees 1 lakh. Okay, 3,50,000 will be payable. Now double taxation avoided via tax credit method. Now we will go off to the second method. Second example. Written when foreign tax is higher. Case 2. Mr. B, Indian resident, earns rupees 5 lakhs from USA. Okay. Now USA tax rate is 40% and Indian tax rate is 30%. We have already assumed 30% here. If it is given, it's good. If it not given, I am taking just example 30%. Now foreign tax paid for 40% on 5 lakhs will be 2 lakhs. Okay. Now Indian tax on the same income, 30% of 5 lakhs, 1,50,000. Credit allowed will be lower of 2 lakhs and 1,50,000 because as per 90, section 90, lower of the 2 is allowed as per section 90. Right? Lower of the 2 allowed on the foreign tax will be taken as credit. So let's see what happens. Credit is 1,50,000. Extra 50,000 cannot be claimed. Always remember this point. Credit is restricted to Indian tax on that income. Okay. Now example 3. No DTAA exists. Section 91, unilateral relief. Okay. Now assume India has no DTAA with country X. Mr. C earns rupees 8 lakhs in India. Okay. And he earns 2 lakhs in country X. So his total income in India will be 8 plus 2, that will be 10 lakhs rupees. Okay. Now he is earning 10 lakhs rupees as per global income for India. Okay. Now Indian tax on total income, 30% of 10 lakhs will be 3 lakhs. Okay. Now tax paid in country X is given 40,000. 40,000 they have paid tax on that. Indian tax on total income is 30% of 10 lakhs, that is 3 lakh. Indian tax on foreign income. Now we have to find out only the portion of foreign income. Foreign income was 2 lakhs. So on that 2 lakhs, how much Indian tax have been paid? On 2 lakhs, 30% will be 60,000, right? And country X is already showing 40,000 rupees they have paid tax on rupees 2 lakhs. So what will the thing as per section 91? Average rate of Indian tax is, we have to find out relief for section 91 comes how? Lower of average rates into foreign income. Okay, so foreign income we have to find out. We have already known that is 2 lakhs here. Lower of average rate. How to find out the average rate? Average rate means amount of tax paid over the income. So here how can we find out the average rate of foreign tax? 40,000 they have paid on how much amount? 2 lakh rupees. So it will be 20%. 40,000 over 2 lakhs will be 20%. Similarly, average rate of Indian tax, 3 lakh rupees he has paid. over 10 lakhs rupees, because that was 30%. Okay, so we find out he was paying 30%. Now for the relief under section 91, lower of average rates, which is lower, 20% of country X, 40,000 they have paid, 40,000 over 2 lakhs is 20%, and he has paid 3 lakhs over 10 lakhs, that is 30%. So lower of the two is 20%. So how much into foreign income? Foreign income is 2 lakhs. So 20%, that is the lower of the two. Lower relief is lower of average rate, okay, into foreign income. So 20% of 2 lakhs will be 40,000. So relief under section 91 will be 40,000, right? Hope this point is also clear. How we took out the average of the rates, right? Now example 4, exemption method under DTAA. Some treaties use exemption method. Let's do one example, very nice. Okay, Mr. D earns salary in Dubai. No tax country, right? As per India, UAE DTAA income taxable only in UAE. If treaty gives exclusive taxation rights to UAE. Okay. So India will not tax that income. Foreign income fully exempt in India. Okay. Fifth example, let's take source rule concept. Company in India pays royalty to UK company. Income under Income Tax Act, 25% TDS. Under DTAA India UK link, 10%. As per, we are doing this as per source link. Okay, source link. Under Income Tax Act, 25% TDS. Under DTAA India UK link, 10%. As per section 92. Okay, assessee can choose beneficial provision. So tax deducted will be 10% into DTAA benefit, right? Treaty overrides domestic law if beneficial. So if there is a treaty which says that as per section 92, assessee can choose beneficial provision. So tax deduct will be 10% of DTAA benefit. Okay, so treaty overrides domestic law if beneficial. Okay, so whenever you are attempting any sum, first identify the residential status, apply residential rule, apply source rule. Okay, check DTAA availability, section 90, 90A. Apply relief method, credit or exemption. Then calculate load of the rule. Okay. Thank you. Hope this is clear to you.